Let me place one number in front of you before anything else. 1 kilogram. Not a coating, not a film, not a trace element measured in parts per million inside a contact pin. 1 full kilogram of refined silver, physical, allocated, deliverable bullion, locked inside the electrochemical architecture of a single next-generation solid-state battery pack. Here is how that number is constructed. 5 grams of silver per individual cell, 200 cells assembled per 100 kilowatt-hour pack. That is your 1 kilogram. And the production line building these packs is not a laboratory prototype sitting behind a glass wall at a trade exhibition. It is a commercial pilot line that has been delivering validated units to automotive qualification partners ahead of a confirmed late 2026 market entry window. Now hold that number alongside this one. Global refined silver mine production across the full calendar year 2025 came in at approximately 25,500 metric tons, according to the Silver Institute's World Silver Survey. Global passenger vehicle production runs at roughly 80 million units annually. At just 20% adoption of silver-intensive solid-state battery chemistry across that vehicle base, the incremental industrial silver demand created by that single application alone would approach 16,000 metric tons per year. That is approximately 63% of every ounce pulled from every silver mine operating on this planet, redirected into one industrial use case that carried a $0 line item on any institutional demand forecast as recently as 18 months ago. I am going to walk you through 8 fresh structural data points across the next several minutes. Every single one of them is traceable to a primary document, a government gazette notification, a sovereign budget appropriation, a corporate industrial disclosure, a regulatory filing, or a published survey from a recognized metals research body. None of this is speculation. None of this is noise. All of it is sitting in documents that the mainstream financial media cycle has either ignored or buried beneath earnings coverage and tariff headlines. Stay with me, because the picture assembling right now across the silver market is unlike anything that has appeared in mainstream financial coverage in the past 12 months. We begin with India, and we begin with a document dated the 17th of April 2026. India's Directorate General of Foreign Trade issued a fresh import authorization notification on that date, restoring 15 nominated commercial banks to full gold and silver import authority under a renewed framework running from the 1st of April 2026 through the 31st of March 2029. That is a 3-year authorization cycle. Why does this matter on a structural level? Because in the first 2 weeks of April 2026, a customs processing freeze had been holding an estimated 5 to 8 tons of silver at Indian port facilities. That metal was stranded. It was purchased, it was in transit, and it could not clear. The DGFT notification on the 17th resolves that backlog and restores the full import pipeline immediately. Now place that against the demand backdrop. India accounted for approximately 21% of global refined silver imports during 2024. The country recorded year-on-year import growth running above 100% across the current fiscal year. And the Akshaya Tritiya festival, one of the 2 highest physical silver offtake events on the Indian retail calendar, opens on the 30th of April 2026. That is 13 days from the issuance of the authorization. The jewelry trade, the wholesale dealer network, and the bullion banking system inside India's domestic market have been handed a 3-year green light at the exact moment seasonal demand is moving into its sharpest acceleration window of the year. The downstream effect on Dubai free zone premiums and Singapore vaulting network arbitrage across the remainder of April and into May is something every silver investor watching this needs to have mapped before the Akshaya Tritiya window closes. The second structural event has been available inside a published sovereign budget document for months, and Western financial media has treated it as though it does not exist. Under the Russian Federation's 2025 through 2027 federal budget framework, published by the Ministry of Finance, the Russian State Fund has allocated the equivalent of approximately $500 million across 3 years for precious metals acquisition. The critical detail, the detail that separates this from any previous Russian reserve management cycle, is that the authorizing language inside the budget statute explicitly includes silver alongside gold, platinum, and palladium as a permitted reserve acquisition asset. Read that again carefully. For the first time in the post-Soviet monetary era, silver is listed by name inside an official Russian sovereign reserve acquisition framework. Russia mines approximately 40 million ounces of silver per year, placing it among the top 10 global producers. The Central Bank of the Russian Federation is now positioned to acquire silver directly off the domestic refinery output stream using ruble liquidity that operates entirely outside the SWIFT settlement architecture. The historical significance here is considerable, since the United States fully depleted its strategic silver stockpile in the early 2000s. Not one systemically important central bank anywhere in the world has carried silver as a named component of an official reserve basket. Russia has now broken that 20-plus year absence with a gazetted, appropriated, and operational sovereign statute. The second-order question, the one worth thinking through carefully, is what happens to the reserve management conversation inside other emerging market central banks when one G20 sovereign has normalized the concept of silver as a reserve asset inside a published budget law. Now let me build the full architecture of the solid-state battery demand story. Solid-state battery technology replaces the liquid electrolyte used in conventional lithium-ion chemistry with a solid conductive medium. The silver-carbon composite anode design being commercialized uses silver as a structural and conductivity component at the individual cell level, not as a surface coating, not as a contact material, but as an integrated anode constituent at approximately 5 grams per cell. The global solid-state battery market was valued at approximately $380 million in 2026, according to published industry research, and is projected to grow at a compound annual rate above 40% through 2031, with longer-range forecasts placing the total addressable market above $25 billion by the mid-2030s. The automotive qualification timeline for first commercial vehicles using this chemistry is confirmed for the late 2026 window, with mass market design integration targeted across the 2029 to 2031 product cycle. Now here's the supply math that makes this the most consequential single demand variable the silver market has faced in the modern industrial era. At 20% adoption across global annual vehicle production of 80 million units, that is 16 million vehicles, at 1 kilogram of silver per pack, that is 16,000 metric tons of incremental silver demand per year. Against 2025 global mine production of approximately 25,500 metric tons, that single application at partial adoption consumes the equivalent of 63% of world mine supply. At 40% adoption, still not majority penetration, the math pushes past the entirety of annual global mine production. The Silver Institute's April 2026 World Silver Survey carried no material allocation for silver anode solid-state battery demand inside its 2026 industrial fabrication projections. That is not a criticism of the survey methodology. It is an honest reflection of how early this demand curve sits relative to commercial shipment volumes. But it means that every institutional model currently pricing silver on the basis of published demand surveys is working from an input set that does not yet contain the largest single incremental demand variable on the horizon. The mid-year demand revision cycle, expected between July and September 2026, will be the first survey update that attempts to quantify this. Watch that date carefully. Mexico is the world's largest silver-producing nation, accounting for approximately 23% of global mine output. The states of Zacatecas and Chihuahua, together, deliver close to half of total Mexican silver tonnage annually. Two parallel risk factors are now converging inside the Mexican silver belt simultaneously. The first is a security crisis that the commodities press has been reporting as a human interest story rather than as a supply risk event. Organized criminal networks operating in the Zacatecas corridor have been running systematic extortion campaigns against mining facilities. Armed groups have targeted concentrate transport routes. The structural cost implications, security infrastructure investment, route insurance, workforce retention premiums, and in some cases, temporary operational suspensions, have not been fully priced into the regional cost curve by any publicly available cost model. The second risk factor is geological. Published reserve data places Mexican silver reserves at approximately 37,000 metric tons. Against annual production of approximately 5,500 to 5,800 metric tons, the reserve-to-production ratio is approaching a threshold that the World Silver Survey flags as the boundary of structural decline territory within the current decade. A major producing operation in the Sonora region is already carrying a guidance reduction of approximately 15 to 16 million ounces against its current operating plan. When the world's largest silver-producing nation faces simultaneous security-driven cost escalation and geological reserve depletion against a backdrop of zero new major silver discoveries entering the development pipeline at scale, the supply side of the silver balance sheet develops a structural fragility that spot price volatility masks almost entirely. The fifth data point sits inside the ETF flow data, and the signal it is sending is unambiguous. Sprott Asset Management doubled the at-the-market equity program capacity for the Sprott Physical Silver Trust from $1 billion to $2 billion in January 2026. The trust currently holds over 200 million ounces of physical silver in allocated, audited storage inside Royal Canadian Mint vaults, with unit holder redemption rights into physical bar form. Simultaneously, the largest silver ETF by assets under management, a product held inside a major U.S. commercial bank custodial structure, recorded net outflows exceeding $2.5 billion across the trailing three-month window through mid-April 2026. Capital is moving. It is moving from the largest unallocated commercial custodial silver vehicle in the world toward the largest Crown Corporation allocated physical trust in the world. And the trust receiving that capital just doubled its absorption capacity at exactly the moment the rotation accelerated. $2 billion at current silver prices purchases approximately 54 million ounces of physical silver. Institutional holders engineering that rotation are not doing so on the basis of a short-term price trade. They are doing so on the basis of custodial risk differentiation and physical allocation certainty. That is a structural positioning shift, not a tactical one. Silver does not move in isolation from the monetary environment, and the monetary environment in April 2026 is providing a clear directional tailwind. The US dollar index has been trading under sustained pressure, pushing non-dollar store of value assets, including silver and gold, into a persistent bid environment. The Federal Reserve's balance sheet management operations have been expanding system reserves at a pace that multiple independent strategists have characterized as functionally accommodative, regardless of the stated policy rate. Gold is currently trading near $3,300 per ounce. Silver is printing near $37 per ounce on current spot. The gold-silver ratio sits near 89-1. Historically sustained gold-silver ratio compression has been associated with periods of acute physical silver demand outpacing paper market supply. The lease rate signal is the most technically specific indicator of physical market tightness. During the acute tightening window of January 2026, one-month silver lease rates reached levels on intraday prints that the London forward market had not recorded in over a decade. Retail silver premiums in several Asian markets reached 40 to 60% above spot during that window. These are not paper price signals. These are physical delivery market stress signals, and they leave a structural mark on how the dealer network and the wholesale vaulting community recalibrate their buffer inventory management going forward. I will not build a one-sided case and call it analysis. The bearish argument has real substance, and you deserve to hear it without softening. Solar cell silver intensity continues to compress. The photovoltaic industry's shift toward higher efficiency cell architecture has been reducing silver paste consumption per cell, and the Silver Institute revised photovoltaic silver demand downward for 2026. Industrial fabrication contracted in 2025. Jewelry and silverware demand are both projected lower for 2026 than for 2025. The broad institutional consensus price forecast for silver across 2026, averaging the published targets from major bank research desks, sits materially below the January 2026 high. Several of those desks have not revised their 2026 forecasts upward despite recent price action. COMEX margin adjustments create deleveraging risk on any sustained risk-off macro event. A dollar recovery driven by geopolitical safe haven flows or a surprise Fed hawkish pivot could push silver back toward its early April support levels. The solid-state battery adoption timeline is a 2029 to 2031 mass market story, not a 2026 story. The demand volumes that make the supply math extraordinary are 3 to 5 years out. Between now and then, the market must navigate a demand curve that is transitional rather than transformational. The bearish case is structurally coherent. I am not dismissing it. But the leading indicators, sovereign reserve inclusion, the DGFT 3-year authorization, the Sprott ATM capacity doubling, the solid-state battery industrial disclosure, are all pointing in the same direction simultaneously, and leading indicators, by definition, move before the price. Let me close with the full verified data picture. Silver spot price, approximately $37 per ounce, April 2026. Gold-silver ratio, approximately 89-1. Global silver mine production 2025, approximately 25,500 metric tons. Structural silver deficit, 2025, approximately 182 million ounces per Silver Institute April 2026 survey. Solid-state battery silver intensity, 5 grams per cell, 200 cells per 100 kilowatt-hour pack, 1 kilogram per vehicle. Commercial vehicle target, late 2026. Incremental demand at 20% EV adoption, approximately 16,000 metric tons annually. Russian sovereign silver allocation, approximately $500 million 2025 through 2027 federal budget. First explicit silver inclusion in modern Russian reserve law. Indian DGFT authorization, 17th of April 2026, valid through 31st March 2029. 15 nominated banks. Akshaya Tritiya window, 30th April 2026. Mexican reserves, approximately 37,000 metric tons against approximately 5,600 metric tons annual output. Security risk events active across Zacatecas corridor. Major producing operation guidance reduction, approximately 15 to 16 million ounces. Sprott Physical Silver Trust ATM capacity, doubled to $2 billion January 2026. Holdings above 200 million ounces. Largest silver ETF 3-month outflows, above $2.5 billion. 1-month lease rate peak, January 2026. Multi-decade high intraday print. Asian retail premiums, December 2025 through January 2026, 40 to 60% above spot. The screen price is the lagging indicator. The Indian DGFT notification, the Russian federal budget silver statute, the solid-state battery industrial cell specification, the Mexican reserve depletion trajectory, and the Sprott institutional capital rotation, those are the leading indicators. The screen catches up to the leading indicators. It always has. The question is not whether. The question is, when you position relative to the moment it does. If this breakdown gave you data that your current research stack was not carrying, share this with one person who is still making allocation decisions based on bank consensus targets that were written before the solid-state battery commercialization timeline compressed, before the Indian DGFT 3-year authorization dropped, and before a G20 central bank put silver inside a sovereign reserve statute for the first time in the modern monetary era. Subscribe and hit the notification bell. The COMEX May delivery cycle is active. The LBMA Vault data drops in early May. I will be back within hours of every release. The leading indicators are live. Watch them carefully.